Hello and welcome back, guys. So in this particular session, what we will be discussing about is McVeigh. Okay, so it's McVeigh is a public limited company, has a reporting date of 31st May 20x3. McVeigh granted free loans of 10 million to its employees on 1st June 20x2. That means exactly 1 year ago. The year with the loans will be repaid by employees on 30 X4. Okay, so after 2 years, but no, now we have a reporting period of 31st May 20x3. We have crossed 1 year, right? So on 1st June 2023, the market rate of the interest of 2 year loan was 6%. Okay, at the reporting date, the credit risk associated with the loan was low. That means only loss of 12 months should be possible credit loss, right? Or loss allowance, you can say. So only accounting entry posted by McVeigh in respect of the above transaction was a charge to 10 million cash outflow to the SOPL as a cost of sales. So this needs to be reversed, right? So this needs to be reversed. So basically what we will need to do is that, so advise the director of McVeigh as how to correctly accounting for the transaction in the year ended 31st May 20x3. Okay, so let's talk about IFRS 9 first of all. So the loan to entity, is a financial asset. This is because McVeigh has a contractual rights to receive cash, right? So if they had a contractual obligation to pay cash or transfer a contractual financial asset or obligation to transfer another financial asset, then it would be liability, right? Whereas in case of equity, there is no liability of transferring, or there is no contractual thingy obligation to deliver anything. Okay, so to receive cash from its employees. So since they have a contractual rights to receive cash, so that's why it's a financial asset. And then as per IFRS 9, financial instrument requires certain financial asset to be initially measured at fair value less, not less, so it's an asset, right, plus transaction cost. What else cost do we add in some situation, right? In some situations. And then normally the fair value is a price paid. However, however, an interest-free loan and loan is not taking place on the same terms as it would exist between market participants. In this case, the fair value must be estimated as the present value of future receipts using the market rate. Okay, market rate. So after that, what we do is that the difference between the fair value of the loan and the face value of the loan will be treated as the difference, okay, as employee compensation, or will be treated in accordance with IAS 19 employee benefits. So how will it be basically treated is that fair value of loan right, at 1st June 20x2. Yep, 20x2, so 2 years, right, discounted at 2 years. So that means how much will it be? Into 1 divided by 1.0, 1 divided by 1 point, market rate is 6%, and then 10 million, right? Okay, 10 million. So $10 million, 1.06 to the power 2, right? So this will give us $8 point, how much will it give us? So let's calculate one more time. 10 divided by 1.06 to the power 2, 8.89, right? So which means 8.9 million. And then employee compensation will be the balancing figure, which will be basically 8.9 minus that will be 1.1 million, right? So this will be cash paid, right? Cash paid to them are 10 million, right, to the employee. Don't need to be in bold. Okay, so entries would be basically be debit financial asset, $8.9 million, debit employee compensation, will be $1.1 million, credit cash or cost of sales, right? Because it has already been, remember over here, the cost of it was charged to cost of sales, right? So they had done debit cost of sales, and then after that they had basically included within this, right? So we need to reverse it. That's what I'm doing. So debit cost of sales, right, which will basically be 10 million. So what do we talk about? The employee compensation will be charged to SOPL over the 2-year period Okay, recognizing it on a straight line basis would lead to half being charged in profit or loss in current period, whereas the other half would be recognized as a prepayment on SOFP. So as advance, okay. And then after that, so it's loan assets, right? The loan assets should be measured at amortized cost because they cannot be traded as these loans are with employees and there is no evidence or the business model is simply to collect contractual cash flows, right? Interest income will be calculated using effective interest rate, which is 6%, carrying amount on SOFP, carrying amount of loan on SOFP at the year end 31st May 20x3 will be how much? Will be dollar 8.9 into 6%, right? 8.9 into 6.6% into 6%, 0.53. So 0.53 will be added, right? So 0.53 will be added, that means 8.9. So 9.43 million, which is basically $8.9 million plus 20% into $8.9 million, right? And the entry will be debit financial asset, and then this will be 9.43, and credit will be finance income, $0.53, right? Okay, so this will be 0.53 as well, right? So why am I? So that financial asset already includes 8.9, right? So using an effective interest rate, okay, so that will be the entry at the year end, and then after that IFRS 9 requires that a loss allowance is calculated for financial assets measured at amortized cost and fair value through other comprehensive income, right? And unless the financial asset is equity, McVeigh should or must calculate loss allowance equal to 12-month expected credit losses, because the credit risk has not increased significantly, right? Because credit risk at the reporting date is low, and therefore there has not been a significant increase in credit risk since inception of the loans, right? For loss allowance will be charged to SOPL and will reduce the net carrying amount of the financial asset. Right? Anything else? Since we don't have the required information to calculate loss allowance, so we don't need to worry about it. So since it is only 7 marks, right? So that is done. Let's look at B, okay? Okay, so plan A. So all of McVeigh's new employees are auto-enrolled into its defined contribution pension plan, okay? However, McVeigh has established a voluntary fund in order to provide enhanced benefits to its employees. McVeigh has also accounted for plan A as defined benefit plan. Okay, McVeigh has a history of paying benefits to his former employees, even increasing them to keep up with inflation. Since the commencement of Plan A, the main characteristics of Plan A are as follows. Plan A is totally funded by McVeigh. The contribution to the plan are made periodically. The post-retirement benefits is calculated based on percentage of the final salaries of plans participants dependent on years of service. According to the online contract, McVeigh can terminate Plan A whenever it wishes. If this occurs, McVeigh must fund lifetime annuities for retired scheme members. McVeigh accounts for Plan A as defined benefit plan. So, second is McVeigh has another defined benefit pension plan. For long-standing employees, the net deficit recognized at 1st June 20x2 was 125 million, and the interest rate on good quality corporate bonds at the date was 4%. The net interest component of 5 million, which is 125 into 4%, okay, has been charged to SOPL, and the current service cost for the year was calculated using assumptions as at 1st June 20x2 and expense to SOPL as a part of service cost component. On 1st March 20x3, the members of the plan were offered a settlement or loss on settlement of 3 million was calculated and accounted for as a part of service cost component. Okay, that's what we normally do, because service cost component includes past, present, and then any settlement gain or loss, right? So this was determined by measuring the deficit on 1st March 2023, both before and after the settlement being updated, both before and after the settlement using updated assumptions. On 1st March, the quality rate had fallen to 3%. The measurement loss has been calculated and is being released to other comprehensive income over the average remaining working life of the pension of the scheme members. The loss is presented as an item that might be classified to profit or loss in the future. Discuss why it was appropriate to treat Plan A as defined benefit plan rather than defined contribution plan, and then discuss whether the recognition of net defined benefit liability in accordance with IAS 19 is consistent with the recognition criteria and conceptual framework. So we need to compare the standard and the framework. Advise the directors as to why the current accounting treatment of B is incorrect. Okay. So first thing first, why Plan A was treated as defined benefit plan. This is about Plan A, right? A defined contribution plan Defined contribution plan is one where an entity has no legal or constructive obligation to pay further contributions if the fund does not have sufficient assets pay all the employee benefits relating to employee service in the current and prior period. A constructive obligation arises when past behavior creates an expectation that the entity will discharge certain responsibilities in the future. All post-employment benefits plan that do not qualify as a defined contribution plan are by definition defined benefits plan. Alright, so in this case they still have an obligation, isn't it? Okay, so let's explain it. There are various indications that plan A should be accounted for as a defined benefits plan. Why is that? First reason, McVeigh, does it have a history? History of paying, right? Has a history of paying pension benefits and has therefore created a constructive obligation that it will continue to do so. Benefits plan or the benefits payable are linked to final salary raise, thus potentially creating a plan deficit. Due to its constructive obligation, will need to increase its contribution if there are insufficient plan assets to pay for the promised benefits. Alright, so if let's talk about this point. If it terminates the plan, lifetime annuities for retirement scheme members. Okay, lifetime annuities, right? If McVeigh terminates the plan, it has a legal obligation to pay for further contribution in order to purchase lifetime annuities for retired scheme members. McVeigh has both legal and constructive obligation to pay further contribution into the scheme, and therefore it was classified as defined benefit and okay. So second thing is about how is it consistent with IS 19 is how is it consistent with recognition of this thing, right? So it talks about obligation, right? So even if it's a obligation, it should recognize it. That's what it talks about. So it's consistent on that regard. So we will use that as a point as well. The conceptual framework states that an item should only be recognized if it meets the definition of an element. The definition of liability is that it is a present obligation as a result of past event to transfer economic resource. However, conceptual framework notes that not all elements are to be recognized. Only those that provide the relevant information and a faithful representation of the underlying transaction is recognized, right? What else? So a defined benefit plan, benefit if it meets the definition of liability, it represents a legal obligation, legal or constructive, you could say, constructive obligation to transfer economic resource because the entity must pay additional assets into the scheme in order to fund post-retirement benefits promised to employees, right? Defined benefit benefit deficit is reduced by the fair value of the plan assets. This is because the plan assets reduce the entity's obligation, resulting in a single net obligation, the one which is essentially the promised benefits not yet funded, which a reporting entity is liable for it. Recognizing a defined benefit deficit provides relevant information to the users of financial statements. Net deficit represents the present value of the unfunded net promised obligations. This deficit will need to be funded by transferring additional resource so such transfer of resource will eventually reduce the investment and dividend payments. A company with a large defined contribution entity with a defined benefit with a large defined benefit deficit may be viewed by potential investors as risky, which may affect their economic decision, right? That's our primary purpose as well, right? An obligation is complex to measure because it involves making assumptions such as employees' life expectancy and final or average salaries. And you could say inflation as well over here. Inflation is assumptions involve a lot of subjectivity and thus are liable to errors and bias. However, IAS 19 recommends the use of qualified actuary so that the assets and liabilities or I mean assets and obligation, I should say, obligation of the underlying scheme are faithfully represented. Moreover, the standard requires extensive disclosures to enable users to understand the estimation techniques used and the sensitivity of the deficit to wider economic change. Plan B, right? Question number 3 is about advice as to why the current accounting treatment of Plan B is incorrect. Okay. Recent amendments to IAS 19 specify that the calculation of past service cost or a gain or loss on settlement or curtailment requires the calculation recalculation of the defined benefits deficit using the latest assumptions. These updated assumptions to be used when calculating the net interest component and current service costs for the remainder of the reporting period. Alright, and what has happened? Was calculated the assumption as at first June. This is on 1st March, right? So that means Plan B were offered a settlement. Okay, updated assumptions. The settlement June, July, August, September, October, November, December, Jan, Feb, March. Okay, 9 months. After 9 months,